So we have 2 o'clock and we have a dense program for the afternoon. So I suggest that we get started on time. And we have 4 papers in the afternoon session. Let me say one remark ahead of the start of the session. So the whole, let's say, workshop or conference that we are doing is a bit of an exploration into a theme that has not really been reflected strongly in academic research, the role of the state in banking. And what we have been hearing and seeing so far is both an exploration in history, so going through time, but also cross-country. And in a way, we continue this in the afternoon. For me, when we discussed this seminar or this conference early on, there were 2 questions that I find of particular interest, and I will, of course, watch them also in the afternoon, as I did in the morning. The first one is, under what conditions are public banks able to achieve added value? Right, so the added value would a bit, the question, is this just a substitution of public against private, or is there something added to it? And this is related to my second question, which is a bit on the details of how public banking activity is eventually organized. Namely, what is special about banks' publicness? So the fact that they are public, what exactly makes this type of work special? So I will explore these issues now, basically using the 4 papers that we will hear now as material. And I want to hand over to Michael Schwan, University of Cologne, with a political science background, if I understand properly, mostly sociology, political science, who will talk about weathering the storm, financialization, and German savings banks. So I'm very curious to hear what you have to say. So Michael, the floor is yours.
Thank you very much. Thank you for the introduction, and please excuse me being late to the party, but currently I'm in Washington, D.C. as a research fellow, so I think it might be understandable that the time difference of more than 6 hours now again, it would have been kind of hard to me to stay awake despite the fascinating papers, and I've read some papers with great interest. And yeah, thanks for featuring me here on this panel. So I get right to the very core of my argument. Let me share my screen. Okay. So that should work. Okay, so my topic, and I hope it fits the theme what you have just been describing. My topic are German savings banks. So some might say, in addition to public development banks, some of the key actors when we talk about public banking today in Western economies, at least. And I tackle this issue because when I started looking at savings banks, I looked a little bit with some colleagues at the Landesbanken a couple of years prior to that. But when I focused on the savings banks, I came from an angle of financialization research, which is sort of a broader theme that I'm interested in. And very briefly, you see here the outline. I'm going to talk a little bit very briefly about each individual aspect to give you a nice rundown of this research project and the main findings. So the motivation. Coming from a political economy, political science background, so not a fully trained economist, which gives me a different perspectives sometimes. Financialization research has become increasingly popular since the 2000s, and especially after the financial crisis, as you might know. And we know a lot more about all these processes: household debt, public debt, and so on, the financial sector itself. But still, we know, I think, too little about how financialization actually affects different financial institutions in a narrow sense and different types of banks, because much of this research is either focused completely on the Anglo-Saxon world. Now there is, of course, expansion to other parts of the world, developing countries and so on, some case studies on select countries as well. But very rarely it is actually that people look at different financial institutions aside from hedge funds or asset managers or big commercial banks. And also we have, when we look at Germany, we have a puzzling assessment, I would say, of the German financial system itself. So we see, coming from political economy literature, again, we see a broad-based trend of, by and large, liberalization in many aspects of the political economy, the labor market, the welfare state, and so on, since the 1980s, 1990s. Then we see sort of also a partial reversal of those trends, which we might call a hybridization in the end. So it becomes more complex, actually. And on the other hand, we have especially the Sparkassen, the savings banks, often seen as bulwarks against financialization, as sort of stable anchors in the German financial system, role models for what we call relationship lending. So what has happened to the German savings banks as central pillars of the country's financial system, and also on a broader scale, because the financial system is one of the key subsystems of the political economy of a country, to the country's growth model or variety of capitalism as comparative political economy would look at it. So in order to provide some answers or some stimulating thoughts on that, I followed a certain research design that asks, have German savings banks indeed weathered the storm of financialization, or have they sort of had to adapt to it in a way that they also consciously used or adapted to some of the trends, some of the perceived perils, or some of the changes that this poses to them, and have they actively engaged with them, or have they become more like private banks even? In order to do this, I amend the concept of market-based banking and apply it to a least likely case. So if there is savings banks in the world, it has to be the German savings banks. So there is no other big sector like that anymore. It's a theory-driven descriptive analysis. So there is it is not about like very strong causal claims. It's more about testing the concept. I'm sorry, there is something going on outdoors here. And it's a structured focused comparison of two diverse cases. So I try to control for the regional context and for the size of the institution. So I compared specifically to Sparkassen, but always keep in mind the regional association and the national context. And my period of analysis is the 1980s to very recently, 2019. Of course, I conducted expert interviews and consulted various primary evidence. So the concept of market-based banking. What you see here very briefly in a very condensed way is sort of a very stylized comparison between what we might call traditional banking on the one hand and market-based banking, or as I call it, amended market-based banking, because my concept comes from different sources on the other hand. So there are 5 key dimensions. One might say there are also more dimensions. Maybe others say, I don't think that this dimension should be part of it, but let's agree for the sake of this paper right now for these 5 dimensions. The 5 dimensions are: how do banks generate income? How do they fund their activities, so the liability side? What happens once they have made a loan in the classic, so to say, business model versus the market-based business model? How do they deal with risk, and what accounting practices do they apply? And as you can see in a very stylized way, again, we have basically 2 eras: the era of financialization, so the recent era, and the previous era of Fordism, and they sort of align with those ideal types of banking. So from boring banking to roaring banking, others have called it. And what is interesting for market-based banking is fees have become much more important for several reasons for banks, as opposed to exploiting the interest margin. Wholesale funding, money markets, and so on have have become much more important as opposed to deposit funding by on a retail basis. Securitization of loans, of course, is probably the key factor. Hedging against risk using various techniques of scoring, pooling, and so on. And also a mark-to-market accounting or fair value accounting, as opposed to the old German commercial code, for instance. And I try to show that to some degree, some aspects are true also for savings banks, and others might be too exaggerated. So we have to have a nuanced understanding of what is going on in that sector. My case selection, as I said, savings banks are crucial. They are the oldest or among the oldest financial institutions in Germany. They mirror also the federal political structure of the country, which makes it also hard for us to study them sometimes. So they are in regional associations, of course. They generally operate under public law, which is a specificity. There are some private law savings banks, but they are kind of rare, although there are some big ones among them. And they vary enormously in size and territorial coverage. So when you try to zoom in and analyze a savings bank, there probably you have some kind of a selection bias. If you only look at the Frankfurter Sparkasse, for instance, then you might miss out what's going on in the northern part of the state of Hessen. And similarly in other parts of the country, if you try to compare those institutions. So what I did, I tried to control for a common regional context, which in my case, as a person from Cologne, is the Rhineland and the Rhenish Savings Banks Association, but for different local contexts. So two different savings banks anchored in local environments. And I could try to control for balance sheet size, so a small and a large savings banks, in order to make sure that it is not those factors that actually drive my observations and my differences. Came up with the Sparkasse Köln-Bonn and the Sparkasse Bad Honnef. So a very interesting institution, by the way, that no longer exists, unfortunately. So here you see the distribution of all the back then, 2018, existing Sparkassen in Germany, just like on a string, a box plot of the balance sheets. And what you see here, my two cases sort of are on the very opposite ends of the distribution. Most of the Sparkassen, as you see, have a very, rather on the smaller end of the balance sheet size. With at the max, so the median is right 1 billion. And most of them are below that, or 50% are below that, of course. And some are very big, like Köln-Bonn, who has now, I checked it, in 2020, surpassed also the 27 billion balance sheet size mark. So those are kind of the opposite cases. Regionally, you see here where they are situated, of course. Köln-Bonn.
We cannot hear you properly at the moment.
Okay.
At least I couldn't hear him properly. So
better now?
Well, just maybe
I just continue. Yeah, I do my best. I'm sorry for that. Köln-Bonn is the product of a merger of two formerly as well big savings banks, Köln and Bonn, of course. So we see merging and concentration process in the sector, of course, going on. And Bad Honnef has just, as I mentioned, has just last year or the year before, 2019, been merged into the Kreissparkasse Köln. So it no longer exists as an independent institution, which is interesting because when I did interviews, there was a saying that if there are only two savings banks in Germany remaining one day in the future, it's going to be the Savings Bank of Germany and the Savings Bank of Bad Honnef. But this is no longer true. So they couldn't withstand just the appeal. So here are the empirical results, some numbers. So this is the income side. So what you see, the black line is the continuous line is the big guy, Köln-Bonn, and the dotted line is the smaller thrift, Bad Honnef, and the lighter continuous line is the whole German savings bank sector. And the data goes from 85 to this is 2018. but 2019 would be the same trend, and 2020, I mean, okay, it's COVID, it's maybe a little different. And what you see here is that throughout the time, net fee income and commission income as a percentage of net interest income has become more and more and more important, specifically in the case of the smaller thrift, which is interesting. So if we see that as a measure of financialization, then the smaller Sparkasse is even more pronounced than the bigger one. Of course, we know that we have the zero interest rate environment. We have other factors contributing to that. We have also customer behavior that is changing. But this is a clear trend that runs across the banking sector and has not stopped at the doorsteps of savings banks. We see, though, a partial reversal in the very end, or a slowdown of that. I think much more interesting is also the funding perspective. Again, the thick black line is Köln-Bonn, and the rest you can see. And here the trend is somewhat the other way around. So we do not see a continuous increase of money market or wholesale funding, like we would see if we had looked at the Deutsche Bank, for instance, with increasing numbers since the 1980s, of course. But we see an inverted U shape, meaning there has been, or there was something going on, but for some reason a reversal has happened, and so back to the basics, or back to the old model of deposit-heavy, customer-oriented or customer-based retail funding has occurred again, specifically after the financial crisis. So there must be a crisis effect, and Köln-Bonn is a prime example for that, where they also said that they particularly changed their business model as a reaction to that in terms of money market funding, because the balance sheet explosion that they were witnessing and enforcing in the 2000s in order to do more proprietary trading and become more active in other parts of the market, they scaled down on that for several reasons. And this is the reversal that you see. So quickly, the last three indicators, which of course could be discussed in much more detail in the paper. I hope I was able to do more justice to that. What you see in terms of the securitization of loans, it's a very interesting thing. I just read about it yesterday again, because of the COVID effects on the German banking sector, on the Sparkassen. So securitization, normally Sparkassen cannot engage in securitization activities of their loans, for instance, because it's just too complex for them, they're too small. But we have the Sparkassenfinanzgruppe, right, the red S. And they, together with DK Bank, with the Landesbanken, they can do it, they offer these services. Cologne Bonn has made use of it. I have no evidence that Bad Honnef has made use of it. And we have now the Sparkassen credit basket, which it has been growing ever since and has proven to be actually a vehicle for stability in that sector. So that's an interesting fact. But as you might read the paper, there are other aspects that would relate more to classical financialization, market-based banking, like private institutions have done it with special purpose vehicles, with outsourcing and so on. So there has been something going on in that sector, but it's much more complex than the other numbers that I showed you. Risk management and accounting, those are the remaining ones. So risk management, I mean, everyone's applying those techniques now. But what is interesting for our purpose here is, so derivatives are used, but Bad Honnef discontinued using them. So they were not really sure about it. Actually, maybe there was even no need because of the specific customer structure of that thrift. But what is interesting is that as the more you use, and this comes from the relationship versus standardized lending literature, the more you use these techniques such as individual rating, scoring, and so on, many interview partners described it as a loss of the gut feeling that you as a thrift do not know your customer, or you are sort of asked to not know your customer as well anymore as you used to, because of the standardization of the risk management that has to be implemented. And accounting, I mean, this is the final thing It's not mandatory for the smaller ones. Some do it, most don't do it on a fair value basis and stick to the German HGB, which is much simpler for them, but also less transparent in a way that if you compare it to international standards, of course. So 2 quotes to close it. So I think this is a particularly interesting quote. The interview partner from Bonn said, "Automation and outsourcing dramatically changed our staff structure. More complex tasks in the background now had to be taken care of by newly hired specialists with skills in abstract thinking. Other former thrift bankers then had no choice. They had to decide whether they could transform from gatherers into hunters and become effective salespersons."
Michael, I have to interrupt you. So I have really forgotten about my role to be a timekeeper. Your time is up already since 5 minutes.
Oh, my time is up. Oh, because my watch showed me 1 minute left. So I'm sorry. Yeah.
But just make a short.
Yeah. So you see this transformation going on also in the way they try to redesign themselves. This is about brand building, another interesting aspect. So if we wrap it up, you see, I would say, without any strong causal claims, this is up for future research. German savings banks have undergone fundamental change. We have seen a differentiation both, I would say, externally and internally. Externally meaning versus the private sector, they are still different than from the Deutsche Bank and the Commerzbank, but they have in some instances become much more alike. And also over time, as I showed you, there's a build-up, an acceleration, a slowdown, and maybe a reversal of some of the indicators. And internally, we see also differentiations in urban versus rural areas and small versus large thrift. And this is, I think, the food for future research that we should really care about when we talk about how do public banks change in the era of financial markets, globalization of financial markets, and how can they still make a difference and what are obstacles to that? Thank you very much.
Yeah, thank you, Michael. So I have to apologize for not being a good timekeeper. I hope I can do it better in the next round. I just forgot about it. So I think it was interesting talk. Let me just start with one short question. So why do you use the term, why you use the category of financialization? I couldn't really see, isn't your result showing that this is not a meaningful category in the first place? It's just modernization. I mean, you connect to more sources of market development. And if this is financialization, so what's the point?
Should I answer right away or do we collect?
Maybe we collect. So I have one in the chat. Mark Cassell, public savings banks have a lot of reserves, particularly smaller ones in the East, although they don't sell their loans. Don't savings bank make use of the DK Bank investment, which allows smaller institutions from large market-based funds? How does DK fit into Schwan's typology? So it's almost in the same line as you were saying in the end, and what I was asking. And Armin Haas, have you noticed any change in the role of Sparkassen for financial local business? So maybe 1 minute for a response.
Okay, so for local business, I have not looked particularly into that, but I think so far what we can say is they are still the strongest lenders on that side, and they're very important for also local political economies in Germany. So I think they keep doing their job, the job that they're supposed to do, and in that sense. So the what was that again? Your question about financialization. Yeah, I'm aware that this is a difficult term if we talk about it in this environment. Why do I connect it to that? So financialization, of course, means a lot. In general, it means, if we take the broadest definition, the rise of the importance of the financial sector, its institutions, logics, and instruments for various other actors. And if we now compare what you said in the beginning, the public mandate and sort of the private business aspect of it, then similar to other public banks or the state itself, we could make the legitimate case saying, actually, what the role of the state or of the broader public should be, yes, modernize on the one hand, but maybe also not adapt to everything that's considered to be out there as the new business model, sort of to be a counterweight to fulfill the public mission. And the same way as we have seen that sovereigns, for instance, in debt management have changed their behavior. Some have benefited from it, others have not. We have seen banks doing these changes. And I'm saying that we have to be careful when we look at public banks, not to confuse modernization with assimilation to private sector banking practices and sort of a diminishing role of the public mandate. And this is why I applied this concept, because the market-based banking concept is at the core of what I call.
Okay, thank you very much. There's much more to be discussed here, I think, but it's very interesting to get some let's say, viewpoint from the political science perspective on finance, which works with these rather rough categories. And when applied to really detailed work, it gets blurry. That's my impression. So thank you very much. And we move on to the second paper or second talk by Marcel Gehrung, whom I saw already earlier. That is here.
Thank you very much for the opportunity to present here. And in line with papers we already heard this morning, we're now going back to Italy, especially to the south of Italy, to the Mezzogiorno region. We're also staying with this weather theme. Michael was looking at a storm brewing above German savings banks, and we're looking on the Italian sun over the south and the regional banks in Italy. As the title suggests, we're looking at the Italian economy, which is very divergent. We have the economically strong northern regions with a very diverse and vivid banking system, and a rather weaker in economic terms south in the Mezzogiorno regions. So Italy is subject of many studies, specifically also from an institution point of view, political science with political patronage, different judiciary efficiency, but we are now especially looking at regional banking systems and the effects of financial development and the diversity of banking systems on economic development. For that, we developed 3 research questions. The first one is also in line with centralization, which happened across the Italian banking system over the recent decades, where the Italian banking systems, which was also very local, very decentralized, moved to a more centralized banking system. And we are now looking whether this harmonization in a negative sense led to weaker economic performance in the north and to a assimilation in comparison to the south, where the economy was weaker already before. We also look at times of financial crises, whether the northern Italian regions lost their resilience against crises with this centralization of financial systems. And lastly, we also look at, besides economic development, also at income inequality and whether a more decentralized banking system as in the north actually leads to less inequality. As I said, the economy of Italy is very divergent. We see here the 3 key economic factors: GDP per capita, the net disposable income of private households, and the unemployment rate. And we always see that the northern parts of Italy with the blue lines perform better. They have higher economic development, higher growth, higher household incomes, as well as lower unemployment rates. In the literature, there are several factors mentioned for this development, why the north of Italy is stronger, but also why the Italian economy is weaker in comparison to the rest of the European Union or of the Eurozone. The first one is loyalty-based and non-meritocratic management culture. It's not deciding who performs best, but rather who has the better connections in the economy. And this also relates to differences in institutions and legal enforcement. The judiciary efficiency in the south is weaker, is less good than in northern Italian regions. It takes longer for processes at court of laws to go through. We also have differences in the banking efficiency and the channeling of funds, differences in the capital allocation, and the transversion from funds from capital rich persons to entrepreneurs which actually need financing. There's always the role of political connections, political patronage. Politics has great influence in economic decisions and onto firms, and there's just in general differences in total factor productivity in comparison to other European countries. So these are the standard factors which are mentioned in the literature when we're talking about the Italian economy, but we add to this, we close a gap in the literature, and we specifically look at financial systems and how diverse or how decentralized financial systems are. We have here the number of banks per 100,000 inhabitants, and we see that the non-Mezzogiorno regions have much more decentralized banking systems with more banks per inhabitant. Historically, since the 1930s, Italy was rather decentralized with a large number of banks. Over the 1990s and also with the historical events which Maria told us in the morning, the Italian banking system went to a more centralized version. There were a lot of bank mergers, increased centralization. We have now a lower number of banks in Italy, but not specifically of regional bank branches. So the banking system is still very spread, very wide across the country, but the banks in total have been reduced. Nevertheless, the North and the Northern banking systems of the Northern region show much more diversity and a greater decentralization. Why should we now care actually about this banking system and how far financial development, how far the spread of the financial system goes in Italy? We have the standard factors from the literature, the facilitation and acquisition of information, the insurance of payback of loans, the maturity transformation from short-term deficit to long-term loans, delegated monitoring, delegated contracting, and specifically in the case of financial development, the reduction of barriers to financing. And what is also important in this context is the last paper I mentioned here by Sharp, that not just the creditworthiness of customers is important, but also that the banks can actually show and signal the trustworthiness of themselves and transform this good information and this good behavior to their customers and to other banks. So it's important that the customers perform, but also the banks. Also, in relation to the paper by Michael, what is also important is the relationship lending and soft information in regional banking. It is actually important that these banks and their clerks know their customers. They are close to their customers. They can build relationships over long times, and they can actually utilize soft information. Then, especially decentralized banking systems and regional banking systems are better in this utilization of soft information. And the theoretical model by Harkness and Schnabel further shows that when banks solely focus on hard information, so especially larger private banks, this can lead to a capital drain from poor to rich regions, which would be especially bad for Italy, where we actually have this divide. Therefore, it might be important that local regional banks counteract these effects. And we also find quite recent literature that the local communities in northern and southern Italy still heavily rely on their small and regional cooperative banks. So much so on the theory. And now we did an empirical analysis. For that, we need data. And we actually look at regions in Italy, and we specifically use the NUTS2 regions. So this is the statistical geographical classification by Eurostat or by the European Union, which divides Italy into 21 NUTS2 regions. And we then assign banks by their headquarters and by their and the postal codes of those headquarters to the specific regions. And we then take the average over all banks, over all banking variables within one region to get a grasp on the banking systems and the financial systems within one region. We have data. Yep.
5 minutes.
Okay. We have data on 1,264 banks. And we assigned those banks by postal codes. And we take our bank balance sheet data from Moody's Analytics Bank Focus. To measure the banking system, we look at total assets for bank size, net loans to total assets for the lending behavior, equity for the capital structure, net interest income for the reliance on interest-bearing business, non-performing loans for risk-taking propensity, and of course, our number of banks per 100,000 inhabitants. Dependent variables are then the logarithm of GDP per capita for development, net disposable private household income to have a look at the income distribution, the unemployment rate for the labor market, and to have this distinction between North and South, we include a Mezzogiorno region dummy and also a dummy for the sovereign debt crisis. For the methodology, we used correlated random effects. Standard fixed effects would drop out our number of banks, which does not fluctuate a lot. It would also drop out our dummies, so we opt for correlated random effects. Still, we have the issue of reverse causality. Did finance come first or economic development? We argue with this econometric approach and theoretically that the shape and characteristic of regional banking systems was established well before our dependent variables. Especially important is here this paper by Pascali, who showed that local Jewish communities were expelled from southern Italy during the Kingdom of Southern Italy and of Naples, and actually moved to the north, where they started to found banks. And these banks are still in place today. They still lead to a much more vivid and diverse banking system in northern Italy in comparison to the south. And therefore, we argue that causality runs from finance to growth. Then to the actual results, we start out with locked GDP per capita as dependent variable. We see the Mezzogiorno regions perform worse, negative coefficients throughout. Also, the time of crisis reduces economic development, especially when we include our banking variables. But we see that this diversity of the banking system, the banks per 100,000 inhabitants, positively influences economic growth and is significant. When we then look at the second variable, the locked net disposable private household income, we again see negative effects for crisis times and for Mezzogiorno regions. Again, we see the positive effects of banks per 100,000 inhabitants. We also see here in one specification that larger banks seem to increase household income, but this will be reversed in a table which I show you in a second. And for the last variable, which was the labor market, the unemployment rate, again, we see that the Mezzogiorno regions have higher unemployment, that the crises increased unemployment. We now have this counterintuitive results that our banks per 100,000 inhabitants increased growth and household incomes, but also seem to increase unemployment. We see that larger banks, however, also increase unemployment. So here again, this importance of small and regional banks with lower total assets in total, but therefore better for their local economies. We see that the reliance of the banking system on interest income reduces unemployment and also a sound capital structure. But we were interested in this comparison between the north and the south, between Mezzogiorno and non-Mezzogiorno. And we see for the Mezzogiorno regions, so for the south, the banking system is not so important in general. There's lesser significance, but especially the northern system actually benefits from their regional banking systems, from the decentralized banking systems. The crises, of course, also affected the northern regions, but they profit from their local banks, from the decentralized banking systems. Larger banks seem to increase unemployment, decrease household income in the north. However, the reliance on interest business, what is also a characteristic of small regional banks, are positive, as well as net loans to total assets. And to sum up, the number of banks positively influences growth, increases net disposable household income. We see that the Mezzogiorno regions are behind their northern neighbors. We see also that increased lending by banks boosts GDP, but lowers household income. And we also see that especially larger banks are not always beneficial to their regional economies. Coming back to our initial research questions, we do find no evidence that the northern regions actually went into a race to the bottom, were harmonized with their southern neighbors. The Mezzogiorno regions are still lagging behind, but the north did not fall there. They still rely on their diverse banking system and are more resilient to economic shocks. Yeah, thank you very much, and I'm looking forward to your questions.
Yeah, thank you, Marcel. So let's see whether we have questions in the Q&A session. Why all banks in Italy? Marcel asking, isn't a bank type that is important? How many public? So it's in general, the question is how does your presentation relate to the other papers on the conference on the of public?
And that's a very good question. And that's also a point which we are looking into now. So we had to do some more work to actually classify those banks, because bank focus does not specifically mention if they are savings banks, cooperative banks, if they are private. So we had to go through their names sometimes to see the specific naming, if they have Sparkasse in them or cooperative bank. And that is the next step, to not look at banks in general in the number of banks, but specifically at their types. Yeah.
And then there's one on your model setup in the econometric model. did you account for potential spatial autocorrelation due to spillovers regarding economic activity and labor market outcome across provinces? So I interpret the question as, how do you reflect merger activities among banks in your...
Yeah, so that's a bit of a tricky issue because we do not have such a long time span. So we only have 6 years where we actually have a lot of data and where we can rely on the data. So that's also an important point, which is still up for discussion and which we should look into.
So I was thinking about the same question when you showed us that increasing the number of banks, or was it it was the number of banks, also leads to higher unemployment? Was that
when we looked at the whole of Italy, that was a bit counterintuitive so far. Yeah.
Why is it? I thought it's quite intuitive. You have very small banks in a number of small banks. You don't measure something like concentration index or so. You just count the numbers, right?
Mm-hmm.
So if you have small banks, because it's a very regional, very rural area, let's say, so all banks are small, then this could be happening. The more rural the area, the larger the number of small institutions which have not yet merged into something bigger, and unemployment is then also higher in that region.
Yeah, very valid point. And also a good interpretation, which I might use. And we're also looking at concentration measures now in the next step to, correct for that it's not just the sole number, but also how, clustered the banks are.
Yeah, I think it makes a big difference whether, so you're counting number of banks or number of bank places? So
no, the actual banks. Not the branches, but the actual banks, yeah.
So if you have a few large banks with very many branches, you may still have small banks everywhere, but to count it only as one unit or 2 units.
We of course, again, because we just have the data for the headquarters or for the big centers, and we also argue that, of course, the regional management is more important than just mere branch management, and have to opt for the headquarters.
The issue whether what you are measuring with a number, I mean, if it's not somehow normalized or standardized with some measure of size or that gives you an impression of the competitive intensity or something like that, and the number can be a bit misleading, right? Because small number of big banks that branch out everywhere are nevertheless a small number. So then your interpretation would be really centered on the governance of banks. If that's your intention, I don't know, but then this would make the difference, right? Because of the difference between many small banks and one large bank with many branches is governance, not presence in the space.
Yeah, very valid point.
Okay, so thank you very much, Marcel. We move on to the third paper, Oskar Kowalewski. I hope he is here. I couldn't see him at the end of the break. Is Oskar there? Yes, he is wonderful. He is. So state-owned banks and international shock transmission. Oskar is from the IESEG School of Management at the Polish Academy of Science, or somehow associated to it. So I look forward to your presentation, Oskar.
So once again, thank you, and sorry we cannot be together. It's a new paper, so I will try to do it as fast as possible, but any comments will be useful. And as my colleagues are from the central bank, so the usual disclaimer applies. Okay, one moment, I hope. Okay, so the motivation. So there's a big literature on foreign banks showing that they stabilize during host crisis, especially in emerging markets. And at the same time, looking on the recent financial crisis, on the global financial crisis, we know that foreign banks sometimes can act as external shock amplifiers. So what is interesting, or when at some point when I was working on this topic, I realized that what we do, we always look on foreign banks and then we look on state-owned banks, but we never look on I would say on state foreign banks. In this case, some of the foreign banks, I would say the government-owned banks, that decided to move abroad. When we look on Germany, you had a period where a large number of, I would say, the Landesbanken, they moved abroad. I would say very often they were not very successful, but there is this case that we know that government-owned banks, they have this, from time to time, this idea to move abroad. And when I was looking on the data, I realized it's a number of banks, and I would say they are not normally, I would say, universal bank. They are mostly wholesale bank, but still it's a number. And what we were trying to look in this paper, the idea was, do they behave the same way as private-owned banks, or they are different because they are state-owned banks? So if you look on the literature, I would say one is the literature which I already mentioned on foreign-owned banks. So they show they are different when we compare them with private-owned banks or domestic-owned government-owned banks. And then we have this literature, but it's mostly related to state-controlled banks. It shows that they are less efficient. At the same time, there's this literature showing that this state-owned banks, or I would say domestic state-owned banks, they help to, I would say, to absorb the shock, especially during the global financial crisis. So this is also when this discussion again started. State-owned banks good or bad? Until now, still there's no really, I would say, one answer to these questions. We know for sure, I would say, that the majority of the papers shows that state-owned banks underperform. But once again, they only look on state-owned banks in the domestic market. None of the studies which I know so far look on how they perform abroad. So what we do, we decided to take all the banks. So as my previous author, so we use Bank Focus, but in addition, we took Bank Scope. So we are going back to 1996. And our data spans to 2018. Maybe we will update it now because we could start now the remaining 2 years. But the problem is the data is big. We have 102 countries and we have almost 10,000 commercial banks. Okay, so in our data set, we have commercial banks, but we also have big saving banks, the ones at the top. And some of our cooperative banks, again, the ones which are normally seen in the countries as commercial banks, but the idea is the problems of Bank Focus, which also my previous speaker told that how they are defined. So theoretically, all the banks are typical commercial banks. We excluded, or we tried to exclude all those, I would say, special proposed state-owned banks in order not to create a bias. How we define a state-controlled bank? So in our case, we follow the literature and we decide to classify a bank as a state-controlled if the government controls at least 20%. So why? Because in most cases, the government doesn't need more than 20% in order to put enough pressure on the management to go the way which the government would like to see the bank going. At the same time, we follow the literature and we call a bank with its foreign owner when at least it has 50% of capital. So if we want to classify a bank which is a foreign government-owned bank, so it means at least 50% needs to be foreign owned, and of those 50%, at least 20% needs to be owned by the government. Otherwise, we will call it either with this threshold is not met, we will call it the domestic. If this one is not met, we call it then private owned. So at the end, we have like 4 groups of banks. So we have foreign and domestic private owned and domestic private and government owned banks. So we use a simple OLS. We have decided to use the most simple way because, and at the same time, we cannot use fixed effect because ownership doesn't vary across time. So the idea is we look on the loan growth. This is the real credit loan growth. We take it and in domestic currency, because a large number of papers use US dollar, but we have a large number of countries in our sample, and there was a lot of foreign exchange fluctuation. We have decided to calculate the real credit growth and domestic currency. Then we have a number of controls for the bank. Then we have ownership, and then we look on different crisis periods, as well. We have host country control variables, which I will show in a moment. So this, I would say, the main regression. So the idea is this is the bank level variables like liquidity, loan to deposit, profitable solvency, and size, so which is used mostly in the literature. Then we have the variables which are controlling for the country. So we look on the distance, on language, if there's a common law, GDP growth, and CPI, so inflation. And this is what we are mostly interested in. This is for just the main regression. So this is the dummy for government domestic. In line literature, we find in all regression it's negative. The first two columns shows the total period, so from 1996 to 2018. This is the time period. The first, third, and fourth column shows the time period before the crisis, so till 2007, and this shows after the crisis from 2018 to 2018. So we see that in all the periods, the government-owned banks are underperforming or providing less loans. If you look on foreign ownership, we see some changes. So we see that in line what the literature was telling, that foreign banks, I would say, provided more credit than domestic banks. And this is what we can see if we look on the total period, and we see it's mostly driven by the period prior to the crisis. And then we have the global financial crisis. And what is interesting, that seems that the foreign banks are not lending more than they did it before. So it seems they scale it down. And this is where we also distinguish the government and private foreign banks. It seems that the situation that both were providing, I would say, loans in the foreign markets, but following the crisis, we see a scale down. And if we look on the coefficient, we see it seems slightly that the government owned banks, the foreign government owned banks, provided slightly little more loans prior to the crisis than the private owned. But I will show you now some differences which we found out. Okay, so first we look on the how systematic banking crisis. Once again, there's a literature showing that some of the it's a discussion, but overall there's this idea that the foreign owned banks can stabilize domestic markets. So the idea is if you have a crisis, the foreign owned banks can help you stabilize the market. So we see if there's a crisis in the host market, indeed we see a decline of lending. And then if we look on government owned banks, the domestic ones, it's not surprising, they still provide less loan, but it's insignificant. We see that when we look on foreign ownership, it seems insignificant, it's positive, but once again, most of the studies which we are looking on emerging markets, while we have 100 countries, well, we have both industrial countries and developing countries. But what is interesting is if we look on who was stabilizing, and then if we distinguish if it's a government-owned bank or private-owned bank, we find out that during a host systemic banking crisis, it's more likely that the government foreign banks were the ones which provided loans. So these were not the private-owned banks. They were more likely, I would say, a much bigger share was provided by the government-owned banks. One thing we could explain maybe that the government-owned banks, they assessed the risk of the country differently than the private-owned banks. Maybe it's also because of the founding, so it's much more easier for them to found it abroad and then use this money in a host country. But we see that there's some difference. So going next, in the literature, we look what happens when there is a home systemic banking crisis. We see it's, once again, if this means where the home country of the government-owned bank, of the foreign-owned bank is, we see it has negative impact on the host country. But what's interesting now, we see a change. So it means if there's a crisis in the home market, now the foreign government-owned banks are scaling down and private-owned banks provide more credit. And this is like, I would say, when we think it's logical, it's probably the government-owned banks need to support, I would say, their own economy. At the same time, the private banks, they look for opportunities. So it's aligned with the internal market. So they use the substitution effect. So as in the home market, they cannot provide more loans. They will go to the market where there's no crisis. And that's why we see a jump. So we see they behave differently. Then next, we look on the global financial crisis. What is interesting, we don't see any big difference. The only what we see that it's again in line with the literature, we see that then the government domestic banks are helpful. So that the idea was the foreign owned banks, both private owned and government owned banks scaled down. But then this is where the domestic banks, government owned banks provided stability. And then lastly, we decided to look on sovereign crisis. So what's interesting, we find out if it's a host on home sovereign crisis, there is a negative impact on lending. But then if we look on government-owned bank, we don't see a strong effect. And then we look on currency crisis. So we see if it's a currency crisis, if it's in a host country, it doesn't have any effect in the home country. It's, I would say, more or less logical. The effect of a currency crisis, even on government-owned banks, it seems to be quite weak. We see there's some effect in the host country, but again, if you look on if it's a domestic or foreign or private or state-controlled bank, we don't see big difference. So the idea is, if we look, I would say the two main ways from our paper at the moment is, one thing what we see, there's a big change how foreign banks, both domestic, foreign, and state and private owned behave following the global financial crisis. So just now, what is interesting, if you look at what we see, it means that we need once again to think how foreign banks behave, both domestic, state and private owned. Another thing what we find out is, what is interesting, that during domestic banking crisis, we find out that indeed more likely the foreign state controlled banks provide those stabilization. While now when we look on the current situation, we don't find the same situation. If we look on the home country banking crisis, what is interesting, the foreign state-controlled bank, I would say they transmit those crises, while those private banks provide more loans. So maybe even there is some kind of substitution effect. It's equalizing. And then what is interesting, what I said, if we look on the global financial crisis, we see this both, that the state-controlled foreign banks and domestic state, the foreign state and foreign private banks, they behave the same way. So we don't see any difference in ownership. But still, what I said, it's still a work and a progress. So we will now make more sensitivity analysis, so we probably can provide more answers. So I hope it's it. That was in time.
Thank you. Thank you very much, Oskar. That was tour de force.
Yeah.
On the last point with the GFC, so GFC is probably distinct in your data set because it has the crisis in both markets, in the home and the host.
Yeah. So when we look, we look on this as a special kind of case because it's in both cases. Okay, so we assume, okay, this is the GF. So we have, in this case, we control, I would say, for all the countries. We assume it's, even when we know that some maybe countries were not as strongly affected, we assume that at some point everybody was affected by the global financial crisis.
Right, but I just say that I mean, that's where you find no different behavior, right?
Yeah.
Is when they have the crisis simultaneously.
Yeah.
But if you have only in one place, then you find that behavior.
Yeah.
It's basically related to what is happening in the other country that decides what I'm doing from what the foreign country is doing relative to a domestic bank.
Yeah.
Okay, so let's look at questions. a very long questions by Mohammed Yilmaz. Are your results sensitive to different choices of ownership threshold for defining a bank as foreign or state? So is this classification always clear and unique, or is it a bit shades of gray in terms of ownership?
So, okay, so what we do, we don't really control for the different ownership. So at some point we decided to use a dummy, and then the idea is we went, because there are too many banks, so I have to admit, so you use a dummy, and it would be nice, but then once again, maybe at some point with a smaller data, smaller sample, we could do it. And there's this question about US banks, so we decided to exclude bank holding companies, because it's a complicated how to treat this bank holding. So we have US companies, but we don't have the holding companies. So we have the US commercial banks. So at the end, we use OLS, which is weighted, because US sample is the US banks is dominating our sample. But if we exclude US, it doesn't make any difference. Even the idea is to keep US is always a problem, because if you look on the number of state-owned banks in the US, there's nothing. So, but excluding it, again, the question is why we exclude it. So there is always this problem we had with US, keeping or excluding it. But then we have it, but it doesn't have any impact on our results.
So what, if I may ask just a concluding very quick question, only a few words as an answer, please. So what are you aiming for in terms of the final, let's say, concluding statement of your research? Is it on the governance of banks? I asked that question earlier, but
what we find is that I would say there's a difference between, always when we talk about foreign ownership, we think about one type of banks. But what we aim to say that you need to look if it's a domestic or government-owned bank, because we show they are different. Okay, especially they behave different during different kind of crisis. Okay, and that's is what you see if it's a.
That relates your work to the theme also of this conference, right? So it's government-owned domestic banks that somehow behave differently. That's what you're looking for.
Yeah.
Okay, so I think we have to conclude, but thank you very much, Oskar, for this nice study. And I want to turn the podium to Dan Mocanu from Scienes Po in Paris, who, together with Matthias Thiemann, has written a piece that looks at public development funds in venture capital markets in Europe. So, Dan, the floor is yours.
Thank you very much. Can you hear me well?
Yes.
It's a great pleasure to be here. Today, I'd like to introduce you to a paper I'm working on with Professor Thiemann, which traces historically the changing role of the EU in European venture capital markets, which are markets for high-risk equity investments in innovative startups. The growth of venture capital markets is often associated with private initiative, market forces, and the virtues of individual entrepreneurship. However, existing research shows that almost all VC markets across the world have been engineered by states, although their modalities of intervention showcase a great diversity of modes of engagement. Our focus is on the increasing engagement of European Union in VC markets, which the European Commission has recently turned into an ambition to leverage the expertise, financial resources, and market reach accumulated over the last decades in order to breed EU-based unicorns, that is, startups with a market capitalization of over $100 billion, as a pathway towards safeguarding technological sovereignty, steering the transition to carbon neutrality, and competing with American and Chinese giants. The increasingly assertive role of the EU in shaping innovation for VC markets is based on a qualitative shift in the EU's self-understanding as a global actor, as an expression of the intense geopolitical competition at the technological frontier, on the one hand, and the growing footprint of public funds in European venture capital markets on the other hand. The public funds, the share of public funds in European venture capital markets averaged 30% of the total VC investments over the last 10 years. In our research, we find that the EU is no longer a regulatory state par excellence, as much of the literature over the last 2 decades makes it to be. Today, more than ever, we argue the EU guides investment decisions in the economy and seeks to steer innovation ecosystems in line with public policy goals. This role is enabled by the build-up of infrastructures to channel investments, which evolved more hidden in the past 2 decades, basing themselves on the blending of EU budgetary means with the capabilities of national and European development banks, but which reached a qualitatively new level toward the end of the Juncker Commission. We trace these developments through a historical reconstruction based on an analysis of market data, a diachronic reading of policy documents, industry publication, as well as a limited number of expert interviews. And we seek to distill path dependencies, contingencies, and qualitatively new developments at the discursive level, and then to distinguish empty words from consequential new orientations at the factual level. Unraveling this historically lasting engagement of EU public funds with the VC market and contrasting it with the rather limited regulatory attempts of the EU to engineer common judicial framework for VC in all EU jurisdictions, we think that sheds a different light on the EU, not as a rule-making entity, but rather as an investor and as a catalyst of the formation of expertise and skills in the venture capital market, without which the market would be much less developed. In this graph, you can see the growing role of public funds in European venture capital markets. And moving on to the analysis of this symbiotic engagement of the EU with VC markets over the last 3 decades, we identify 3 stages, which can be schematically described as an evolution from market crafting to market fixing to market shaping. And then since 2017, we can distinguish an assertive role of the EU toward going beyond this market-centric approach, toward shaping not only markets, but innovation processes themselves through an ecosystem approach. However, these stages were not necessarily mutually exclusive, being at times complementary and layered. These stages can be better understood by looking at the interaction between the market context, the rationales used to justify public engagement, and the key policy initiatives that gave expression to those rationales. In the first stage of the EU public engagement, the market context was characterized by an accelerated expansion of fundraising and investment volumes, driven especially by private banks, corporations, and institutional investors. It was also characterized by a high degree of spatial concentration, with the EU accounting for about 40% of all investment, a fragmentation across national borders, and a chronic undersupply of capital for early-stage high-tech ventures due to the more risk-averse profile of institutional investors in the EU compared to the US, for example. After some policy experiments in the late 80s, in the mid-90s, the EU engaged for the first time in a systematic market crafting effort in response to 3 challenges. First, the discovery of the so-called innovation paradox, that despite its globally acknowledged scientific excellence, the European community was lagging behind in terms of innovation and in terms of commercializing scientific research. Second, the second challenge was the relocation of European startups and talent to the US. And third, the poor rate of high-quality job creation in the EU. In this context, publicly supported VC markets engineered by the EU aimed at building a pan-European venture capital market as a catalyst of high-quality job creation, a driver for the commercialization of scientific innovation, and a protector of European talent and ideas. Some of the key initiatives for which the market crafting efforts of these years have materialized include the Risk Capital Action Plan, which aimed at designing the regulatory preconditions for the functioning of a pan-European VC market, as well as the reorganization of the European Investment Fund into the risk capital arm of the European Investment Bank, which empowered the EIF to act as the center of gravity of the market for the next decades. Following the 2001 dot-com bubble, the second phase in the evolution of European VC markets was characterized by a short boom and bust cycle, followed by 5 years of stagnation during the global financial crisis and the sovereign debt crisis. And these developments prompted the flight to safety among institutional investors, a reallocation of capital to private equity that magnified funding gaps. However, these adverse market conditions also triggered greater public engagement in providing counter-cyclical financing to the industry. During this stage, EU interventions were scrupulously embedded in a strict market-fixing approach and always tested against distortionary effects, aiming at filling gaps where markets were failing to efficiently allocate resources. The transatlantic rivalry remained an implicit rationale guiding the VC policy, while market fragmentation and regional disparity have also played an essential role in underpinning EU-level interventions. During this period, the European Investment Fund became a key source of counter-cyclical funding and also the largest institutional actor in the market, accounting for over half of all the public venture capital invested. Toward the end of the second phase,
5 minutes.
Okay, after almost a decade of market fixing, in the early 2010s, the Commission has experienced an episode of soft doubt, driven by two contradictory trends. On the one hand, member states were expressing weak receptiveness to pan-European VC policy initiatives, while industry representatives were seeking to emancipate themselves from subsidies, grants, or protection mechanisms, and were calling for a phased reduction of its dependence on public money. On the other hand, persistent structural problems and the adverse post-crisis market conditions called for a more proactive EU approach. During the third stage, the market has steadily expanded and deepened through a symbiotic interaction between public and private actors. The global digital race has sharpened the competition especially for scale-up funding, which exposed the vulnerabilities of European markets in this segment, in the later stage rounds of the venture capital cycle, and revived public calls for a greater protection of EU innovative startups. Emerging from its post-crisis self-doubt, the EU has increasingly distanced its VC policy from the market failure framework, moving from questioning its own interventions to a more directing role in shaping VC markets, reflecting its growing post-crisis capacity, but also willingness to govern through financial markets. The collaborative links between the EU and the venture capital arms of national development banks have also strengthened during this period. The main rationales that underpin the EU's engagement strategy during this period include the explicit goal of safeguarding technological sovereignty through EU unicorns, shaping markets in line with broader policy agenda, but also engineering ecosystems of innovation at the interface of science and markets. Among the key initiatives of this stage, we can see a growing emphasis on sectoral initiatives, especially deep tech initiatives, as well as experimentation with direct equity stakes in innovative startups as a complementary tool apart from regulatory interventions and funds of funds that define the business model of the EIF. The pioneering initiative that best captures the EU's greater engagement with innovation ecosystems during this period is the launch of the European Innovation Council. The EIC seeks to steer the strategic coordination of EU national innovation ecosystems as a single pan-European ecosystem, while the EIC's investment fund, the EIC fund, is the first ever EU investment fund that takes direct equity stakes in innovative EU firms and provides to them non-financial services to grow into unicorns. Other initiatives that illustrate this trend toward equity investments is the Breakthrough Europe Energy Venture Fund, launched by the EIB with Bill Gates, and the venture debt instrument of the EIB. In conclusion, the engagement of the EU with European venture capital markets over the last 3 decades shows that the EU has made conscious use of markets as a tool of statecraft rather than as a tool for building a level playing field. In terms of the tools of engagement, we can distinguish a shift from legal and regulatory interventions in the first stage toward to investing indirectly via funds of funds, which as I said, is the business model that defines the EIF, and then a more recent turn toward picking winners directly through equity investments. Some of the pending questions that remain to be answered concern the interaction between EU-level policies and national-level initiatives, the issue of how EU-level initiatives are filtered through national priorities, capabilities, and political interests, and how does the field of development banking shape the practices of the European VC market? Thank you.
So thank you. Also a political science view on this, on what we have seen in the European financial politics basically going on. So let me just ask you the question, did I understand your presentation correctly when I summarized that you try to produce a narrative that would encompass what had been done by the Commission and maybe other actors in Europe, maybe not knowingly with the same rhetoric, but if you would reconstruct rationality into this point, then it would be such a story. Is that your aim?
So our goal is to reconstruct how the EU has evolved its own self-understanding of its role in building and steering venture capital markets, and also to map the tensions between how private funds, how the industry itself engaged with the European Commission and with the EIF, and what kind of demands they claimed from the European Union, and how the European Union responded to them, and sometimes acted in a way against what the industry prescribed or what the industry called for. In order to finally show that the European Union is no longer a regulatory actor per se, but has evolved towards a more assertive role in guiding investment decisions and using markets to achieve public policy goals.
Yeah, but that's their narrative, right? Or whether they really did it or achieved it is on a different piece of paper, right? Is that correct? Right? So you are basically trying to tell the story.
Yeah.
That is what you may have had in mind.
Yes.
Okay, but whether you did it or reached it is something else. Right. Okay, I understand. Thank you.
Yeah, it's not an evaluation paper.
Yeah.
Yes.
Yeah,
we don't assess the effectiveness of EU interventions in the venture capital markets.
Yeah. Okay, so that's why I said the narrative. It's the EU narrative basically being produced by you. Okay, that's interesting. And I look into the questions. They are a bit asking different things that are maybe not really too done, but maybe I keep these two questions that I find for the final discussion that we have after our keynote speech. So I thank Dan for your presentation, and I would like to move on to our keynote that comes at the end of the conference, and that is delivered by Fritzi Köhler-Geib, who is the chief economist of KfW. So implicitly we have been speaking a lot about state development banks and about KfW in some papers even explicitly. She is the chief economist since 2019, after having been with the World Bank for 11 years in different roles and in different functions, but mostly concentrated on Central America. Before that time, she was basically studying and writing her PhD with Monika Schnitzer and Joan Ventura in 2008 on something that is remotely related to what we are discussing here, the effect of uncertainty on the occurrence and spread of financial crises, but that has been a theoretical analysis. And now she's, so to speak, in the midst of the practical doing, of the pragmatic doing that we have been listening to for in some talks. And so I'm very curious to hear her assessment of the role of a development bank like KfW under today's circumstances, including the COVID crisis, I think. So the floor is open for Fritzi Köhler-Geit, please.
Yeah, thank you very much for the very kind introduction and also for the invitation to this highly relevant conference. I would like to give a short keynote, and I am sharing my slides. I hope you can see them, with the topic of the role of development banks in the crisis,
Yeah, we can see
COVID crisis, and during transformative times. And as you, Professor Krahnen, already said, of course, I'm adding a practitioner's view, having been for quite some time at the World Bank and since 2019 at KfW.
Yes.
And I'm also very pleased that I don't have to convince you of the relevance of development banks, because this has been part of your discussion the entire day, and I was very pleased to also find KfW in the title of some of the papers discussed today.
I've just.
I would like to,
yes. To presentation mode, because your slides are smaller than they.
Okay, yeah. Okay, sorry, very good point. I forgot about this. So this should be better.
Yeah, much better.
Okay, great. Okay, so as a starter, I would like to take you to a family trip to Heligoland, where I took the picture of the northern gannets that you see to the left. Usually on those cliffs, there are a common bridled guillemots, those black-headed birds on the right that breed. And those birds are truly impressive, because the young birds, when they are fledging, are jumping off the cliffs and then have 3 to 5 seconds to learn flying. And if they don't, well, that has harsh consequences for the bird. And I didn't see those birds jumping, but I did look down the cliffs and I thought, wow, this is quite a good image of where we are as a society right now. We can't do business as usual. We only have very short period of time for a fundamental transformation that we need to learn and to put into practice. And I'm also convinced that it's such a large transformation that development banks will have to play a role in this. And to me, I think there are 3 fundamental questions that I would like to bring to your attention in this context. First question, why do we need development banks? And I'll talk about the example of KfW. The second question is, which role has KfW played in Germany during the COVID crisis? And then coming back to the transformation that I just alluded to, looking ahead, which role can KfW play in the twin transformation that we are already seeing? So I'll start with answering, or trying to give some answers to the first question of why we need development banks. And I think a very fundamental reason is actually that markets do, in principle, deliver good results for many challenges. However, there are inefficiencies due to external effects and asymmetric information, and that is exactly the rationale for development banks or promotional banks such as KfW, and KfW only acts in those circumstances of those inefficiencies to complement the market system. In addition, it has the role of supporting transformations and has done so starting from reconstruction after the Second World War, and also including reunification, with the goal of reaching societal goals. The role of KfW is, or the areas of activity are particularly with regards to climate change and environment. We have external effects with this regard and an under provision of investment in that area. So with market-based instruments, KfW supports the market, and what is really important in the design is that it does so in collaboration with the corporate banking market. So it uses the on-lending principle of basically having commercial banks lend on KfW loans that often have subsidies when it comes to interest rates and so on. The second large area is digitization, innovation, and I'd add globalization in here. And that is mainly due to the fact that banking in itself often underprovides loans for innovative technologies. Many technologies are not bankable, and that particular area where KfW is active, be it through the financing of new technologies, as for example, 2011, the financing of offshore wind parks in the North Sea that were not bankable at that time and today are running highly profitably there. Then there is also the area of social change, or basically human capital formation. KfW has an important program for student loans in this area. And then last but not least, KfW also has some engagement as firefighter during times of crisis, as we have seen during the COVID crisis. So to summarize very briefly, why do we need development banks? The reason is markets do provide important solutions to challenges ahead. However, there are inefficiencies, and that's where development banks can basically support and develop new markets and help with the transformation. And with this, I'd like already to enter into the second question of what role KfW has played in Germany during the COVID-19 crisis. The KfW program during the crisis basically had four main pillars. Importantly, a loan program as liquidity aid for enterprises. Then linked to the paper that we've just heard, also a support for startups. We called it Corona Matching Facility that basically provided 1.6 billion for 2,300 startups. And then also financing of non-profit organizations through the Landesförderinstitute. They were already also mentioned. And then there was the support for students that were provided at zero interest. And this market-based approach, because I think this is really important when talking about the design of KfW, the collaboration with the banking system, and also the fact that KfW hands out loans, complemented the larger fiscal package that the government put together in response to the crisis, and basically helped stabilize the economy. I would like to have a closer look at the heart of KfW's support during the crisis, and that's basically the support program for enterprises. By now, there are more than 150,000 applications for loans with a volume of 66 billion that have been filed, and the largest part of those applications were successful. So about 144,000 loans have been committed with a volume of 52 billion. And I'm very pleased that 98% of those loans benefited the small and medium sized enterprise sector, and 62% of those loans had a volume of less than 3 million euro. And of course, this is, I think, an important factor, because we know that during crisis times we often see concentration in markets because it's smaller companies that often tend to fail. We had the idea right at the beginning of the crisis that we would like to know who is getting the loans, and we basically did a survey with beneficiaries of the program. And because we are doing a yearly survey of small and medium-sized enterprises in Germany, we were able to link the survey data from the beneficiaries with the bigger data set of small and medium-sized enterprises in Germany. So we could see that actually the companies that benefited from the Corona support programs in more cases had revenue losses due to lower demand, that more often they suffered from disruptions in production or service due to problems in the supply chain, and that more often they suffered from disruptions in business operations due to the absence of employees. So one could summarize this as the help reached companies in particular need. We also asked companies what they did with the loans that they received from KfW, and the largest part of the company, more than 2/3, used those loans to pay suppliers. Another 2/3 paid wages and salaries with the loans, and then almost half of them used it for rent and leases, and less companies to establish or expand alternative distribution channels. In particular, the first 3 uses of the loans show that KfW stabilization programs prevented negative spirals in the economy and had an important contribution to stabilizing the economy. With this, I'd like to move to the third question of which role KfW can play in the twin transformation. So we are coming out of this really deep, disruptive Corona pandemic that has shown impact on the companies. Many companies have indebted themselves more, yet we have this transformation ahead that basically means that there are huge investment needs in Germany. We've just published a study that puts a number behind the investment needs for moving to a climate neutral economy. And those needs lie at 5 trillion euro until the mid of the century. They are unevenly distributed between different sectors, with the largest share, around 60%, going to the transport sector, followed by energy and then industry. What's interesting is that those 5 trillion, that when you break them down to yearly investment needs from up until 2045, come to 191 billion per year, are not all additional investments. They also include reinvestment for example, industrial sites. The additional investments are less important, still very high, 72 billion. It is per year. It's clear, though, that this is a high amount. And also when it comes to the topic of digitization, that's why we often speak about the twin transformation in which we are involved. Germany is currently in the midfield of the use of digital tools in the economy, and also when it comes to the development of IT technologies, has some room to catch up, let's say, to leading markets. And when you look into the investments in IT technology relative to GDP, you see that Germany has been spending less than other major industrialized countries, and we've come up with a estimate that basically investments would have to double or triple to be able to catch up with other leading industrial countries, advanced economies. So the investment needs are tremendous, and a way in which we like to think about the transformation and how financial markets can support it, or the financial industry, including banking, is by thinking about the different degree of maturity of technologies, because we will only be able to manage this transformation with technological advances. So there are different financial instruments that need to be used, and sometimes, in some cases, even developed to be able to be successful in the transformation. For incipient technologies that are in the state of research and development, it's basically grants, tax incentives for R&D that are required. When you move towards the market launch of technologies, so and if we think of examples of those technologies that are at the research and development stage, I'm thinking, for example, of carbon capture and storage or carbon capture utilization. It's not yet clear whether those technologies will really be used or not. When you come to the market launch of technologies, it's rather innovation or promotional loans that you need, but also equity capital. And in Dan's paper, we heard about European initiatives. KfW also has a private capital branch, KfW Capital, that basically invests in funds of funds to support the development of the German VC market, particularly important at a point where we need technological advances to manage the twin transformation. But in addition, I mentioned already the financing of wind parks in the North Sea. That was, you could call it, the promotion of a demonstration project that then basically became bankable. And the third stage of technological development would be the diffusion of technologies in the market, and their investment loans or promotional loans are the adequate instrument. So if I put this together, I think that development banks are needed to basically help set incentives in areas for private companies to invest that are characterized by market inefficiencies, but also in a situation where companies are less likely to invest due to a difficult financial situation. And I'm quite confident that if we come up with smart financing solutions and the right incentives, that then we can learn and implement the transformation, that the transformation can fly. And I'd leave it here for some impulse for discussion. Thank you.
Yes, thank you. Thank you, Fritzi Köhler-Geig, for this interesting tour de raison of the reasoning behind the portfolio, let's say, of KfW. Let me start with a question that I have for a long time on my heart. So KfW has been growing significantly over the last couple of years. It's now one of the largest banks in the country. And I'm asking myself, when I hear your argumentation, and to put it very clearly, why do you need a balance sheet to achieve the objectives that you want to achieve, right? So because the objectives you said are we want to nudge investors in doing certain things, we want to develop certain areas more forcefully than otherwise are existing. But for what reason do you need money for that? You could also use subsidies and just in the end you deliver subsidy. Right? So that's the policy. But why do you need a balance sheet for that?
Yeah, that's a very fair question. And I think the main reason for it is that, yes, the rationale is to nudge companies in basically investing in areas that otherwise they wouldn't for individual optimization purposes, but which are a societal goal. And we want to do it through market instruments, because the difference between a subsidy and a credit is that the company that takes the credit still has to pay it back. And it still needs to be convinced that the investment project is worthwhile. It may be that the market provides the financing at a too expensive rate for the company to decide to do it, but you do want to have the skin in the game. So I think that's why it's fundamentally different. And I can tell you from experiences in many crises worldwide, it makes a huge difference whether you hand out subsidies during a crisis or credits, because the credits may come back to you with a return, and that allows you to hand out and help stabilize during the next crisis, while the subsidy for public management is gone.
Yeah, but you could tie the subsidy immediately to the lending. I mean, in a certain sense, that's what you do actually. It's just that you don't hand out the money directly to the companies, but you lend it out to the banks that fund the companies. And for them, this is a refinancing advantage. They get it a bit cheaper than otherwise. So if this a bit cheaper would pay this out in cash, you do not need the balance sheet then.
Yeah, but I think the construction with the banks is particularly also attractive because, one, it allows to act very fast, and Germany was faster than any other European country in bringing funding into the crisis at the time of liquidity shortfalls in the corporate sector. So it's actually attractive to work together with corporate banks. And then it's also the case that you could, of course, and I think that would be also an option in addition, to combine usual loans with subsidies. As I said, I think it's a very attractive and efficient way of combining both, because the company has only one counterpart, their commercial bank, and that basically leaves the banking sector intact, and government only intervening in areas where you actually do see inefficiencies, or where there is the need to help support the development of a new market.
Yeah, I think the first question one question in the chat that I read by Marcel is basically going this direction, and there may not always be clear understanding how KfW disposes of the money. So the question is, KfW COVID recovery is impressive. What role do local banks play in deploying the support? And halfway you have said that already, but maybe you can use the opportunity to explain this again. And do you know why businesses were unsuccessful in securing a COVID loan?
Yeah. Okay. So how does the on-lending principle work? It basically works through the company asking for credit to their partner bank, and the partner bank basically hands on KfW's loans to the customer. During the Corona program, the loans had actually even more beneficial conditions than in normal times. So they came basically with a partial, because the idea is to have skin in the game for all market participants, but partial and relatively high guarantee by the state. And basically the company has a relationship with the bank, and KfW has a relationship with the bank, and the commercial bank is basically the on-lender of KfW loans.
Yeah.
That basically are handed out together at the same time with the guarantee from the federal government. In France, for example, companies need to they don't have the same construct, neither does Italy, and companies basically first need to show to commercial banks that they have the guarantee by the state, and then enter into a relationship with the commercial bank. But oftentimes that's a bit more complicated. So I really must say, having seen it during this crisis, and I hadn't been at KfW before, I think this is a very efficient system of basically having the state complement the market system, for example, in crisis times.
Yeah, and if I look at your slide 11, so not everybody will remember, but it was where you described the use of loans, and for wages, for leases, for rent payments, and you showed us the numbers, and that were quite significant. And when I saw that, oh, you are going back to the slide 11 was this one. So what's the use of the loans? So my first thought was, oh, this is quite dangerous, right? Because you are in a way substituting cash flow by loans, which is the direct road to debt overhang. So my question to you would be, how do you, let's say, control for creating a new problem, which is over-indebted companies that substitute cash flow by debt?
Yeah, no, that's a very fair question. I think that what is really relevant here is the European temporary framework, that basically companies needed to have an intact balance sheet at the end of 2019 to qualify. You had asked also the question of why did companies fail? I mean, that's exactly it. That KfW is basically supervised. It's a bank in that sense, even though with particular rights, because it also has the guarantee from the state, but it actually it has to fulfill the same compliance rules as any other commercial bank. And I think that one, the European temporary framework, but then also it's an emergency loan program, if you wish. Conditions were designed in particular for the fast credit, that it was expensive, so companies would use it as a last resolve. And we've observed that many companies used KfW loans as a liquidity line. They requested the loans, they drew the money when they really needed it, and some companies paid back early. And I think this is exactly what you would like a crisis program to do, basically to provide liquidity to companies that are hard hit, but that are convinced that they will, with the recovery of the economy, generate sufficient cash flow again to recover and be able to pay back the loans. And of course, we haven't seen the end of it yet, and we are seeing, we've done in KfW research quite a few real-time surveys, that the cash flow situation, the turnover situation of companies has significantly stabilized and recovered. So, of course, the neuralgic point will be when public support will end. Will companies at that point be able to roll over the debt, or will they have repaid everything so they are out of the woods? It's very difficult to say how exactly that will look like. However, we are seeing, and we've just published this year's small and medium-sized enterprise panel, that equity ratios in Germany have reduced only moderately. So they dropped from a very high 32% prior to the crisis to a bit over 30% during this survey now. And this is, when we think of the depth of this crisis, a very moderate decrease, if you wish. It is true that there is a divide between large companies and smaller companies, that smaller companies having been hit much harder when it comes to their equity ratios. However, I think it's very important to keep in mind that German companies went into this crisis from a position of strength when it comes to their financing structure. And you could even argue maybe equity ratios before the crisis were too high, because you could say on the flip side, maybe companies for a long while in Germany haven't invested sufficiently, which makes it even more urgent to set the framework, the incentives right, that this will happen going forward.
Yeah, so are there other questions? I don't want to monopolize my privileged position here at the microphone. So please you can also just speak up or give a sign in the F&A or in the chat that you want to say something. So this is really, we are a small group and we are able to discuss, and almost many of those in the room have participated with the paper or with the discussion. So you should please make your viewpoint heard. I would follow up with the following thought. I mean, you have also maybe an overlook about the development banks in other countries in Europe, and I was also like what you said, quite impressed by the speed with which it was possible to respond here, at least in Germany. And I thought it has a lot to do with the way the KfW as the state development bank, there are 48 other development banks in Germany, but this is the most important one, how it collaborates with the banking sector. It's not sidelining it, as we have probably seen in other countries, but it's actually a refinancing option, a targeted refinancing option. So you cannot use it for everything, for certain purposes. And maybe you can say a bit about how do you see this in a comparative way across Europe, maybe, to the extent you know these other countries. And secondly, what is the risk sharing, the typical risk sharing formula between let's say the primary banks that are receiving the refinancing by the KfW and KfW itself?
Yeah, no, that's a very very good question. And as I hinted at before, I think that the way of organizing the public support to the enterprise sector is quite unique in Germany through KfW. And you mentioned the Landesförderinstitute. They were also an integral part, not last with the Corona matching facility to the VC market, but also complementing the support. When it comes to the loans, it's exactly as you said. The guarantee part by the government was increased to 90%, and usually is much lower or is not existent. So it depends on the situation, if you wish, and it depends on how far the societal goal is away from individual optimizations in the private sector to from a business perspective. And that's also, I mean, there is this discussion of how could investment in green technology be incentivized, and whether there is also guarantees from a government perspective needed to make this possible. I think that there are a lot of reasons why companies are very reluctant to invest, and I think we need to look into those areas as well. That's, for example, the uncertainty. I mean, we have a very high level of uncertainty still linked to the corona pandemic and how it will evolve right now, but then there are also uncertainties regarding the general framework, how CO2 prices, for example, will evolve over time. And if I'm a company that is investing or not in new technology, the one price that is really important for my break even is the CO2 price. So I think it's really key that there is clarity about the development of that price, and also not only in Germany but in Europe / in a climate club to actually also address the question of comparative attractiveness of Germany as a business location.
Yeah, but this uncertainty about CO2 prices does not translate into programs of yours, right? It's not that you take over that risk, let's say, that you assume
No.
that. It's
No. No. So KfW has I think plays several roles in this area of green transformation. One certainly is to set incentives through our lending programs. There is the energy efficient building and rebuilding program that over its lifetime has used 180 billion euro in loans, and thereby has mobilized 480 billion of investments, thereby reducing carbon emissions by 12 million tons per year. That is around 1/3 of the emissions from the building sector, or 1/10 of the capacity of storing CO2 by German forests. So it's significant. So through programs, and this is one, there are also programs on innovation and so on that could be in the environment area for businesses. But then there is also, I think, the role in financial markets. KfW is an important emitter of green bonds. And I think the third role is basically showing how bank operation can work under with the goal of reaching the SDGs. So KfW is quite ahead and has mapped its portfolio with regards to the SDGs. And every third euro in 2020 has been spent on climate and environment. If we take out the Corona support programs, it would have been every second euro. And so that's the environment quota of the bank. And I think this is really an important role to basically show that this is possible. And of course, KfW is on a journey there, as all other institutions are. But I think it's something that is taken very serious at the bank.
Yeah. I thank you so for providing these further details. So I think we are coming to a close of our meeting. And let me say one last sentence. So I think what one would wish for as an academic observer is that we would see the counterfactual or estimate the counterfactual. And that is, I mean, we can show and look at what public banks are doing. We can do this in history, as has been done today. We can do it in a cross-section, as has been done today. That's all fine, but it does not really tell us the basic question that has been posed in this seminar. what exactly is the contribution of the publicness, the fact that this financial operation has been done by a public institution that adds value, that it exists, that it can maybe substitute one-to-one or maybe less than one-to-one for an otherwise possible private operation is something that's still in the air, right? And that we would like to know. If we push for more state activity in banking, what we currently do almost around the globe, do we do something overall good or bad? Is this helping us forward or not? The sheer fact that the public banks are achieving something is not sufficient. It's only necessary to make this argument. For sufficiency, you would have to estimate the counterfactual, namely what would have happened without that institution and without that subsidy in place. Of course, we can do this with sophisticated econometric techniques, but it's still ahead of us, and I don't see much academic effort in that direction. But I think as a policy-minded person, I would like to see work in this direction. And I may say this more to the entire group, which sits now around this virtual table, that there is something more to be done, both with respect to historical data, as well as with the assessment of what's going on today in our markets. So unless you want to add something.
It won't console you completely, and it's not attributable to KfW altogether, but Bundesbank did do some estimate of how deep the economic contraction would have been without the fiscal support. No, so of course KfW is only part of it, but the effect during this crisis at least was substantive. And I absolutely take your point that of course is a very interesting question. And for some of development banks around the globe, we have done that at the World Bank. The results, but I also have to say that those banks were not organized as KfW, were not always so very flattering.
Mm-hmm. Yeah, that's interesting. Yeah, indeed. So I see more questions coming up now, but I think our time, we take this home and we'll sleep with them so and think about them. And I think time is out. We are already beyond 4 o'clock and everybody has their schedule and plan. So I want to thank all participants for being here. And also, of course, Fritzi Güller-Geib, who gave us the I would say the cumulative talk at the end. And I wish us all and wish you all a good day and more research and more interest in the role of public entities in banking. Thank you very much.